I'm going to give you 5 reasons why you should buy Toyota Motors stock. The symbol on the New York Stock Exchange is TM. They were established in 1937, which means last year they were in business for 80 years. In 2017, they did $247 billion in revenue. That's the top line on the income statement. If you divide that by the 80 years that they've been in business, that means they increased every single year by $3 billion to get to $247 billion. So in 1937, $3 billion, 1938, $6 billion, 1939, $9 billion, 1940, $12 billion, and so on up until $247 billion. Reason number 2, the balance sheet. If you look at the market capitalization right now, which is all of the shares times the share price, which is very easy to see on Yahoo Finance, look up TM and you'll see right away that they, at $136 per share, they are worth $202 billion. Which means if you had $202 billion in your pocket right now, you could buy every single share and own the entire company. So, if you look at the balance sheet and you take all of their assets, sell them all because something happens tomorrow, pay off all the liabilities, you'll end up with a bottom line on the balance sheet of equity of $181 billion. That makes it a very risk-free investment right now. Most times, the equity is not even close to the market capitalization. There's a huge premium, way higher than the equity. So right now the equity is at 181 and the market cap is at 202, which means if you bought the entire company for $202 billion, you could turn around and sell off everything and close all the doors and fire all the employees, and you would lose $19 billion because you would collect 181. Reason number 3, Toyota Motors does not have any goodwill or intangible assets on their balance sheet. To me, I don't like those things. Things like data and computer systems and brand names are all intangible assets. They are obviously not tangible. You can't touch them. You can't sell them very easily. So if you were to liquidate Toyota Motors after buying them for $202 billion and you liquidate all of that assets and liabilities and you end up with $181 billion, if 100 of that was intangible because it's data and it's consumer data and all kinds of weird intangible assets, then you would not be able to collect that when you liquidate. So I personally always subtract that, and that's equity versus net tangible assets. The equity of a company comes first, and then if you go down one more line, it subtracts the goodwill and the intangible assets off of the balance sheet, and you end up with net tangible assets that you're actually able to sell if worst comes to worst. So they have no goodwill or intangible assets. One more quick word on goodwill. A company that has, like Toyota, $181 billion in equity or book value on their balance sheet. If another person came in and bought that company for $200 billion, a little bit higher than that equity, then they would buy the company for $200. The equity is only $181. So that company that bought them would put the difference into goodwill on their balance sheet, which you can see is almost nothing. It's just a number that's thrown on to the balance sheet. I know that there's probably some experts out there that would say that there's all kinds of reasons for goodwill, and there probably is. But you know what? When worst comes to worst and you have to sell off those assets and pay off those liabilities, there is no goodwill to be found. You can't go into the warehouse and find all the goodwill and put it up for sale on eBay or Craigslist. So you might think that goodwill is worth something, but to me, it's not. And Toyota Motors, the great reason that they are on my list right now is that they do not have any intangible or goodwill on their balance sheet. Reason number 4, the income statement. If you go to the bottom line of the income statement and you take the last 5 years, add them up and divide by 5, you get up the average net income. That's after everything is paid. There's no extras at the bottom of that. After that, you get net income average $22.4 billion over 5 years. That's $100 billion in 5 years. So if you bought the entire company for $200 billion, like we said before, and you have 181 in equity sitting on the balance sheet, that means in 1 year you will have made $22 more billion dollars. Plus the 181 in equity brings you up over the 200 number. So if you bought the entire company at the current share price of $136, then you would make all of your money back in 1 year. That means if you started selling all of those cars and you made $22 billion in 1 year after buying the entire company for 200 or 202, then you would be able to liquidate the next day. Sell it all. Sell off all the property. Sell all the cars. Sell all the assets. Pay off all the liabilities. You would end up with more money after 1 year paying for that company. Trust me, if you do that formula on plenty of other companies, that is a very difficult thing to find. So if you can hold on, if you bought the entire company for $200 billion and you held on for 5 years, the equity would go from 181 to 281. And then if you sold off the assets and paid off the liabilities, you would turn your $200 billion investment into $280 billion. So that is a great investment. You can't do that with any technology company right now, trust me. Reason number 5, the cash flow statement. If you look at a couple of lines on the cash flow statement near the bottom in financing activities, you'll see that they have a 3% dividend right now, and Toyota has been having a 3% dividend for a very long time. If you also look, you can do the math on that, and it turns into a $5.7 billion dividend that gets divided out by all the shareholders, which turns into about 3% on the amount that you have. So $136 share, 1% of that is $1.36. You multiply that times 3 and you get about $4 for every single share that you own right now of Toyota Motors. So just by holding that, even if the stock stayed stagnant for 3 years, you'd still be making a 3% dividend. And it's very likely that the stock price is going to trend upward over the next 3 years simply because the balance sheet is so powerful with that equity compared to the market value. The market value should be more like $300 billion right now, because like I said before, if you take the equity and you add 5 years worth of net income to that equity, you end up at close to $280 billion. So the stock price should at least trend upward until the market cap gets close to $280 billion, because that's not very much of a big premium to get your money back in 5 years. Because if you bought the entire company for $280 billion, you would have 180 in equity, and then after 5 years of collecting that net income and putting it into the balance sheet or into the savings account, you would end up with 280 and you get your money back at that point. So that's a great return on investment. That's 20% on your money. You get it all back in 5 years, and then you just start making money into the future. And they're only growing every single year. Like I said, $3 billion per year since day one until now, and obviously the bulk of those gains were in the later years. They probably didn't do $3 billion on year one and $6 billion in year two, $9 billion in year three. So a lot of that was on the later years, which means they'll probably grow by $10 to $15 billion per year going forward. The second thing on the cash flow statement says that they paid $4 billion to buy back their stock. Now, buying back stock and paying dividends is argued in the industry that Toyota doesn't know what else to do with their money. Now, if they had the $5 billion that they paid in dividends to all the shareholders for owning their stock, and they had the $4 billion that they paid to buy back their stock, which makes less shares available, which makes your shares worth more money, then they would have been able to use that $9 billion towards some investment in a new car or some kind of energy efficient idea, some kind of environmental new idea, something in research and development. They would have been able to use that money towards something to invest and make more money, because investors like to see their stock price go up and they like to see good news and all of these different things that the company is doing. However, Investors also like to see a dividend. None of the new technology companies like Facebook and Amazon pay out a dividend. So if you own that stock for 5 years and it's at $200 and in 5 years it goes up and down and ends up back at $200, you've got nothing to show for that. But if Toyota Motors goes up and down over the years and ends up back at $136 in 5 years, then you also have a 3% dividend for 5 years, and at least you have something good to show for that. Thank you.